So let's talk about auditor independence. In the academic literature, and this is something that academics have, done research on for years and years and years because of the importance of auditor independence. And one definition is auditor independence would be the probability that an auditor will report an error in the financial statements, the probability that they will report the error in the financial statements, given that they've discovered it. So you have to, if you don't discover an error, that doesn't mean that you're not independent, right? That could mean that you didn't conduct a very effective audit. That could just be simple, your audit risk, that you didn't uncover it because you don't provide absolute assurance, because you don't look at 100% of the items, or because the client is just very good at covering it up, right? So the fact that you didn't discover an error doesn't mean that you're not independent. You violated your independence if you discovered an error and did not report that error. Then you violated your independence, right? Because it's your responsibility to report that error, right? So that's a pretty standard definition. So independence is covered under Rule 101. So of all of the standards that we're going to talk about in terms of the professional standards, you must know Rule 101. So when I say Rule 101, it should just be instinctive. You know I'm talking about independence. I'm asking you about independence. So I'm going to tell you, independence is an extremely important standard, and so it's very important that you understand independence, right, and the rules governing independence. So there are two components of independence: independence in fact and independence in appearance. And so the standards talk about independence in fact, right? But most of the standards as written are really geared toward independence and appearance. And the reason for that is the standards, the appearance really deals with what's prohibited, what's allowed, what constitutes a violation of independence. So for example, you have to be independent when you are conducting an audit engagement. So if you are assigned to an audit engagement, you have to be independent of that client. Also, it talks about covered members. So not in addition to the auditor, right? There could be members of the auditor's family that are also have to, comply with this Rule 101, in the sense that if the auditor knows that his or her spouse is a CFO at the audit client, that auditor should not be on the audit engagement, right? So the fact that the spouse is a CFO, it means that if that auditor is on that audit engagement, the auditor has violated independence. So we'll talk about covered member. But the reality of it, independence is so important because it's important to users of the financial statements. The auditor has to provide, the users have to believe or have the perception that auditors are independent, because if not, it undercuts their, their reliance on the financial statements. So I was going to show you this, but